To start things, this is last month's Singapore savings bond rates. 1 year rate, 3.06%. For 10 years, average of 3.1%. I've been advising private clients to buy, and especially when you compare to T-bills, for 6 months only, you get 3.13%. This rate is also dropping very fast. So by the next few issues, you can expect for 6 months, you only get 2+%. So why not lock in 3+% back then, correct? So for the last issue, a guaranteed 3.1% over 10 years really doesn't seem that bad. So what you should expect also coming in the next few months ahead is that banks will start to cut their high yield account rates because T-bills have dropped also already. Right? So with that explained, let me show you what is the latest Singapore savings bond rates, and I know on first glance you'll think it's lousy. But I promise you also, if you understand how it works, it might fit some situations. And very likely, this could be the last Singapore savings bonds that you see me mentioning favorably for quite a long while. And here it goes. At a 1 year rate, 2.59%. And if you stay for the entire 10 years, 2.77% on average. Still above CPF OA rates of 2.5%, but really not fantastic, correct? Because we're now so spoiled by a high interest environment, whereby if you compare back to 2020, 2019, we'll be pretty happy with this. But actually, this drop is not too unexpected. If you see the US 10-year Treasury yield rates, it has been trending down aggressively also. The cutoff date for this issue is on the 25th of September, 9 PM. You can always buy and sell on your internet banking. And what I would suggest is to buy nearer this end date, just in case there's any uptick in inflation number news that could make next month's issue more favorable. But still, that's quite unlikely. If we see in terms of a year-to-date comparison, this table by I Love SSB, you would see that the blue line, which is the 10-year rate, and the green line, which is the 1 year rate, is at a year's low. On a relative basis, really not too exciting. So before we get further, this video is the first part. I will have a next sequel, which is Fed rate cuts coming, 4 places to invest, and subsequent to that, target prices for REITs. So if you'd like to stay tuned for those episodes, smash the subscribe and get notified when they are released. Back to this month's Singapore savings bonds, why it could still be a buy, correct? So let me analyze what are the yearly rates specifically. You would see that on this graph, for the first 3 years, it's at 2.59% flat. But after the third year, there is a big jump upwards. Which means also, if you're looking to invest for 1, 2 or even 3 years, not too good an idea. Hold on a little bit, there might be some 3-year endowment plans by insurers that will beat this rate. And if they do come on, I'll share them on my Telegram channel, so look for links below for it. Then back to this graph, you would realize that on year 9 and year 10, it's close to a 3% mark. That brings up the total 10-year average to be 2.77%. Still quite a bit better than CPF OA rates, and that's why it's still not too bad. I believe also that for the next few issues, if it does go downwards, we might be hearing more people pumping monies back into CPF OA at 2.5% like back in the good old days. So with this information, let's look at how we can positively recycle any Singapore savings bonds, just in case you have previous issues. Do note, every buy and sell transaction is $2, and you can buy and sell any amounts of $500 per block, up to $200,000. Last month's SSB allocation was fully allocated because it was undersubscribed, and I believe these issues will also be undersubscribed. So if you buy 200,000, do understand also that you can always sell partial amounts, such as if you are a retiree and you buy 200,000 of this, you want $15,000 for a renovation or a holiday. You can always sell pieces of 15,000 at any point of time in this 10-year cycle. It's not a lock-in. And because it's not a lock-in, along the way in future, if there's a better offer, simply sell and buy the future one, which means also there's free lunch for you to upgrade. Then the next question is how to actually do Singapore savings bonds recycling. Let me show you some example. This is a quick snapshot for issues in 2022, and it describes when you should sell and when you should keep. Let's use the first August 2022 one. Don't look at the first 2 years, because right now, an investor holding on to their bond issue is looking at the third year onwards, which means an interest rate of 3.07% for third year and 3.09% for next year. So the opportunity cost is higher than this month's issue, which means please keep the bond, don't recycle it. The same goes for July and June's issue, which is 2.8% and 2.68% as the opportunity cost. However, if you look further downwards, May 2022, the opportunity cost becomes only 2.2%. And then for April, at only 1.92%. And that's where I actually encourage to recycle, because there's at least 0.3% difference that you can get when you sell the thing and buy these issues fully. What it equates for every 100,000 is $300 more per year. So still quite meaningful to pay $2 to sell and $2 to buy, correct? And do not waste that timing difference to things. Just in case you have other issues, I've also found a shortcut to determine for you. If you see in this chart, what you can infer is that for issues before June 2022, which is the May, the April issue, and everything before that, you likely can recycle and get a better yield. If your issues are beyond 2022 June, then likelihood keep and stay put. So this graph really tells you very quickly what to do. As always, if you have learned something, help me smash the like button so that we can reach a bigger audience together. So everything mentioned until here, let me show you some solutions. Or maybe you have even maxed out your SSB already. What else can you park your monies into? Firstly, if you are an accredited investor and you'd like to get a corporate bond portfolio, I can build something like this for you. I can put in corporate bonds in pieces so that you can get some diversification and build a bond ladder. I can get you about 4 to 5% in such a structure. And the minimum amounts I'm looking at is at least 100,000. So if that fits what you might be looking for, look for the links below. If you're looking for smaller amounts, then instead I'll build you a cash portfolio. The cash portfolio will consist of low-risk bond funds and is meant to preserve capital. The Fulton SGD Fund has performed 3.8% over the last 1 year. The Nikko AM Center Short-Term Bond Fund has performed 5.24% over the last year. All in all, we've raised more than 250,000 worth of invested funds. And by being a private client, you will get this newsletter that I've specially created to help you in your investing journey. So again, look for links below and let me know in the comment sections what you think of the ideas suggested so far. And thank you for watching right at the very end. With that, let me introduce you to this previous video I have, which is why it's not good to keep absolutely everything in cash for your retirement. If you haven't seen it, check it out. I think it's a very intriguing topic. With that, I'm here and see you there. Take care as always. Goodbye.